Happy Monday, everybody. I hope you all had a great Easter weekend. Well, today I want to look back about a year ago, just over a year ago. If you remember, the bank, Silicon Valley Bank, which we refer to as SVB, they collapsed, seemingly without notice. Now, we had seen some trouble brewing, and a lot of us expected something like that to happen, but the marketplace in general was kind of caught off guard. But it wasn't just SVB, it was also Signature Bank and First Republic Bank, three of the largest bank collapses ever in American history. Problem is, a year later, little has changed. And I see the stage being set for our next banking crisis right now. Because problem is, last year when this happened, Janet Yellen, the Secretary of the Treasury, she announced, hey, everybody calm down, nobody worry. The U.S. Treasury will bail out all the banks that we need to. So don't worry about individuals taking responsibility. Don't worry about banks taking responsibility. The federal government will just do another bailout. And the problem just seemed to disappear, but it hasn't. And that's the thing. So since then, we haven't seen any policy changes. Meanwhile, the banking sector hasn't really recovered. It's just that the population has continued to go on like normal. But if we look at last quarter, and this is the fourth quarter of 2023, the FDIC, and FDIC is the insurance company that insures all the banks. They're also the bank's regulators. Now, they go in and audit banks and see how they're doing. Well, they've got a list of problem banks, and they've added a massive amount of banks to that list, growing that list by 20% just in the last quarter. Now, we don't know about the first quarter of this year yet. Those numbers haven't been reported. But when we look at 2023, that list grew by 20% in one quarter. Meanwhile, here's another issue. There's a problem that's brewing under the surface. Credit cards and commercial real estate loans have had their highest number of delinquencies in over a decade. Since the great financial crisis of 07-08, the highest number of delinquencies. Now, delinquencies are a troubling sign, but they're not a catalyst. The catalyst are defaults, loan defaults, when people just stop paying altogether. Delinquencies is trouble brewing. So if people are paying late on their loans or paying partial payments, those go into delinquent status. Now, if they stay delinquent long enough, the bank has to default on them, take back the loans, and it's a loss. We haven't seen that yet, but we've seen a growing number of delinquencies, the highest in a decade. Okay, so those are a couple of the problems. And here's the thing. Even Jerome Powell, who's the current Fed chair, he said in an interview a couple weeks ago that he expects that the next banking crisis will come from failed commercial real estate loans. So he's even aware of all this trouble brewing. Okay, here's the problem though. The FDIC, that insurance company, they're concerned about this, and so they've been lobbying, trying to force banks to increase their reserves. What's a reserve? Reserve is it's banks' version of a safety net. It's their savings account, and they've got to keep a certain percentage of all their loans in reserves, which means that if a loan fails, they have enough money to go fill that hole that loan created. And the FDIC, they're trying to be conservative, saying, let's save a little more. You know, we got trouble brewing. Let's force our banks to save a little more and create a bigger safety net just in case. But Jerome Powell is pushing against it, and so are the big banks. They're lobbying Jerome Powell, and Jerome Powell is behind him saying, no, banks shouldn't create greater reserves, because what that would do is it would decrease loans being made. Heaven forbid we decrease loans and maybe respect debt a little more. So it looks like that's the policy going to be moving forward, is that banks will not have to create greater reserves so that they can keep making loans and not be any more conservative than they are now. Now, what this reminds me of is when we look back to the great financial crisis. We call it GFC in the finance industry, which then led to the worst recession since the Great Depression, right? About 15 years ago. What we all know now, what led up to that was a real estate bubble where real estate prices were just going sky high. And why were they doing that? Well, because politicians didn't want to slow down lending. They wanted everybody to be able to get a home loan to be part of the American dream, because everybody deserves to have the American dream, which is home ownership, right? And so banks were forbidden from requiring proof of your income. So any borrower could just go into a bank and say, yeah, I make $500,000 a year. And the bank would accept that. They didn't require proof. You didn't have to provide your pay stub or a W-2. They would just take it. Now, they could run credit reports, and the credit report might show that you had horrible credit. And then they would ask the borrower, well, why do you have horrible credit if you make $500,000 a year? And the borrower could say, oh, don't worry, I have a hard time paying my bills on time, but I'm good. Trust me, I've got plenty of money coming in. And the banks would accept that. Well, now if you're listening to this, you're probably chuckling, and we now refer to those loans as liar loans because there's a lot of people taking advantage of the rules and not being honest. That then created more and more loans going after real estate, which pushed the price up. Then the bubble popped, and the rest is history. Well, I see a lot of similar kind of irrational or greedy lending policies that keeps the money flowing. Probably because they're making the assumption that Janet Yellen is just going to say, oh, don't worry, nobody has to take responsibility. We'll bail you out. Problem is, you can't do that forever. And somebody has to take responsibility. So, when's this going to happen? We don't know. In the meantime, everybody watching this video, we're in good company. We all respect debt, right? That's right. And with that, I'm going to let you go. Oh, one more thing. One of our wonderful clients, Troy, he keeps reminding me, if you're watching this video, please go to the bottom, click the thumbs up. What that does, it creates greater visibility. It increases our visibility among the YouTube audience so we can get these videos out further and further. So if you don't mind, please click the thumbs up for mine and Greg's videos. And with that, you all have a great week. Take care. Bye-bye.